Hi, I'm Ken Walters from Kenlock Mortgage, and this is the bottom line on mortgages. If it has to do with mortgages, we're going to talk about it here. And today we're going to be talking about the speech that Mr. Carney gave just a few weeks ago and break it down and see how that applies to your mortgage and what's going on in the economy. If you happen to see me looking off camera today, it's because I do have notes and I am referring to them because there was a lot of information to cover and I wanted to make sure that I brought it to you in a succinct manner. Do me a favor, like and subscribe, at least that way when we put out a video, you're gonna know about it. So Canada's economic direction was laid out in a speech called Forward Guidance. And in that speech, Mark Carney lays out a very clear plan. Now, to be fair, it's actually one of the more transparent economic plans we've seen in a long time. But transparency doesn't mean certainty, and it doesn't mean assumptions behind the plan are going to hold. So what I want to do here is walk through what actually is being proposed, what the numbers say, and where the risks are. Okay, now not politically or emotionally, just what this actually means. At the core of this plan is a very large deficit strategy. We're looking at $78 billion in 2026, $65 billion the year after. That's the largest deficit outside the pandemic in 25 years. And the objective behind the spending is very specific. Attract investment into Canada, create jobs through industrial growth, and improve housing affordability through supply increases and employment-driven demand. So this is important. This is not a plan of lower interest rates to fix the housing market. This is a plan of growing the economy and let housing follow that growth. The main tool being used here is called the productivity super deduction. It allows companies to deduct the full cost of equipment and machinery immediately, instead of spreading the deduction out over time. It happens now. So, for example, a company can finance a $1 million purchase with, let's say, $100,000 of cash today. The tax benefit is the full cost against revenue, which at 27% is worth $270,000. So the government is essentially paying companies that are investing in Canadian growth. There's also a control built into this. Companies have to continue producing within Canada for up to 10 years. Otherwise, there's a recapture penalty. So this isn't just about attracting investment, it's about keeping it here. Now, this is also happening in a very competitive environment, specifically with the United States. Now, the corporate tax rate at the federal level in Canada is 15%. In the US, it's 21%. But once you include provincial and state taxes, both countries are actually about the same, which means the differentiation has to come from incentives, like the productivity super deduction. Now, let's talk about housing. The housing strategy here is focused on supply, specifically rental supply. There's about $2.8 billion allocated towards Indigenous and urban center housing, with projections suggesting up to $130 billion in return. And programs like the Apartment Construction Loan Program and CMHC's MLI Select have already seen an increase in purpose-built rental supply. That increase in supply has pushed rental prices down over the last 3 years. And at the same time, we've seen negative immigration. This combination has pushed vacancy rates up from 1.7% across Ontario in 2023 to 3.5% in 2025, and it continues to increase in 2026, with rates as high as 4% in places like Barrie and St. Catharines. The net effect is smaller individual rental investors want out of the market. They're going to cut their losses and sell. This puts downward pressure on the house pricing because employment now limits the buying pool. This makes this a buyer's market with lower offers being made. So what you're seeing is a shift in who owns rental housing. Now, this entire plan relies heavily on something called the multiplier effect. Look, the projections are significant. $280 billion in public spending. It's expected to generate $315 billion in return. Okay. $1.7 billion in AI is projected to return $210 billion. And $2.8 billion in housing is projected to return $130 billion. And finally, industry and trade investments at $305 billion carries an expected return of only $270 million. So that industrial trade number, yeah, that's not a typo. However, it includes a significant investment in military to meet our NATO obligations, but that's obviously an appeasement to the US as well. But something worth investing in my opinion. But let's be clear, when you adjust for that, take out the military expense, so the result essentially becomes a wash. And to achieve that wash, That's going to require a deficit of $78 billion. So this is where the risk comes in, a literal gamble. Because the success of the plan depends on those projections holding. Now let's layer in current market conditions. Interest rates are sitting around 4%. The Bank of Canada has already warned us that the best scenario is status quo. And if a prolonged war in Iran pushes oil prices, Governor Macklem will not hesitate to increase rates. 3% interest rates might be something you tell your kids about, like boomers talk about 23% interest rates from 1983. There is no expectation of returning to 3% 5-year rates. Housing prices are already on the decline and continue to decline, while rental supply is also increasing. Lower interest rates and population are not going to be the salvation. The strategy here is that a productivity problem needs to be solved with production, not from cheap money. Which brings us to what this really is. This is a long-term economic bet. So, best case scenario, the investment in AI and tech generates enough tax revenue, unemployment decreases, and per capita GDP increases. That's the amount of dollars created per person. So, employment and production drive housing demand. Revitalize the construction sector with housing affordability that leads to lower cost of living. Strong returns on housing investment with the expected ROI of 10 times the spend. Okay, now worst case scenario. The MPO, the Major Projects Office, doesn't actually get anything done faster. The pipelines we're seeing today have been in the works for years. Housing affordability is the result of bankruptcies and defaults in a market that's been losing value for 4 years. That's not affordability. That's a contraction that is crushing anyone that bought during the expansion. So the deficits remain, with no growth to support them. Building doesn't restart, and therefore housing affordability doesn't improve. And there are external risks. The gamble on AI and IP development doesn't generate its 200-fold projected return. Will this even materialize in the face of competition with the US while they try to keep those same sectors? Housing investment appears focused on rental and social housing, so no real mention of driving home ownership, which means the outcome will depend heavily on what the provinces and the municipalities do next. There's also a timing issue here. The expected results are on a 5 to 7 year timeline. So this isn't a short-term solution, and that leads to this final assessment. The plan is transparent. The intentions are clear, but the outcome's binary. It either works and delivers job growth, production, and housing stability, or it results in a significant economic downturn. That's the reality of what's being proposed. But if you want to understand how this affects your mortgage, your buying power, or your strategy, reach out. Because right now, structure matters more than rate, and that is the bottom line on mortgages.